Seminar is now being recorded.
Good morning and welcome everyone to our webinar, Unraveling the Complexities of Expatriate Taxation, How Employers Can Achieve Compliance and Promote Employee Satisfaction. I am Sharon Cook. I'm a CPA with Senior Tax Manager with Gelman, Rosenberg Freedman, and I will be monitoring this program today. Before we start, we have a couple housekeeping. Well, you want to contact GRF at 301-951-9090 if you have any questions. This webinar will be recorded and made available after the event, and please keep in touch with GRF for any future presentations and webinars. In order to get CPE credit, there will be a survey at the end of the program. It will pop up on your screen as the webinar ends. There will be 3 words shared during the webinar, and you will be asked for these words called CPA words and must be completed to get CPE credit. If you have any technical questions, the survey can be addressed to Alina Stone at the following address. When you're taking the survey, please turn off your pop-up blocker to complete it. The presentation also will be available to download at the grfcpa.com website. Following is the webinar objectives. We recommend CPE of 1 hour during this webinar. We are fortunate to have with us 2 presenters that have a lot of experience with expats. Troy Turner is a tax partner with over 20 years experience in expat taxation and other international tax areas. Kate Fiskin is the principal with the Outsourced Accounting and Advisory Service. She specializes in intertax issues with U.S. citizens and resident aliens living and working overseas. She represents industries in the nonprofit and government contracts. This is today's agenda. We will leave 10 minutes at the end of the webinar for any questions and answers. Please submit them during the program. So I'm going to push it off to Kate to start organizational expat strategies.
Hi, welcome. This is Kate Fiskin. I'm very happy to present for you today an organizational strategy of how we can unravel some of these complexities that we all are facing when we send our employees overseas. What usually concerns the organizations that I work with are a number of issues. First off, what are the strategies that make this process efficient? What are the policies and reporting systems that can address compliance, reporting to funding sources, and to keep employees satisfied and productive while working overseas? One of the biggest issues for an organization to address is who makes up your expat team and who's going to be the lead. Finance, global HR, global payroll, grants and contracts, field office, program managers, and many others are some of the people in your organization that you need to include. Then you should ask yourselves, what kind of documentation, information does your organization need to provide all of these folks before, during, and after the assignment? And don't forget the employees. Employees need to be processed, and that's a very important aspect of this whole exercise. How will you address compliance issues of the U.S. and host countries proactively? You also need to know the types of individuals that will become your overseas employees. Obviously, the first is the U.S. expat, including the green card holder. The third country national, dual citizens. And you're also going to need someone to keep track of everyone, know where they are, and how long their assignments will last. Finally, you ought to know what presence you have in a country, the visa processing for each host country, and ask yourselves, before you go to that country, when you're getting ready to respond to an RFP, are you registered to work in the host country? Are there tax-exempt status for you in the host country? Does the host country require you to open a bank account? Does the host country audit you and of all your activities once you're there? Does the host country require a corporate tax return? These are just some of the few issues you're going to have to face, but the goal here is to limit surprises once you get on the ground and are working in the host country. And now I will turn it back to Troy Turner.
Thank you, Kate. So the big question here is, why are we even having this discussion? And you like to think you could send your employees overseas and forget about them when it comes to U.S. tax compliance and reporting. But unfortunately, U.S. citizens and lawful permanent resident visa holders, otherwise known as green card holders, are required to report their worldwide income on a U.S. tax return, no matter where they live and work. So we can't forget about them, and we need to understand what's required when it comes to reporting and how they're taxed. So the primary tax concern for someone when they're sent overseas on a foreign assignment and working in a country that has taxation is, are they going to be double taxed? That's generally the worst result you can have, is if you end up having to pay tax in the U.S. due to worldwide income taxation and local country taxation under some sort of non-resident taxing regime or otherwise. So there's a few things that an individual can do to alleviate double taxation, and they are taking advantage of the foreign earned income and housing exclusions, using the foreign tax credit, and also using a tax treaty or an international agreement that may exempt their salary in the local country from tax altogether. So tax treaties generally work for short-term assignments, but today we're going to focus on employees who are being sent overseas for long-term assignments, so we're going to look at the other areas. So in order to qualify for the foreign earned income exclusion, and that's the primary way your employees are going to look to eliminate double taxation, and if they're fortunate enough to be located in a country that's not taxing them, they could end up with no U.S. tax bill at all after utilizing the exclusion based on their overall compensation package. But to qualify for the exclusion, the first thing that needs to happen is they have to have a tax home overseas. And a person moves their tax home overseas when they're on a long-term assignment, and a long-term in this case means an assignment that's expected to last and does in fact last for more than a year. So in order to make sure that employees don't get hung up on this particular area, I normally advise organizations when they're sending someone overseas on a one-year assignment to not list it as a one-year assignment in the contract or in any sort of internal document, but to show it as an assignment that's expected to last for 1 year and 1 day, or maybe 367 days, but just make sure you're noting that it's going to last for more than a year. That's important. So after a person has moved their tax home overseas, then they must meet either the physical presence test or the bona fide residence test. The bona fide residence test is a little harder to qualify for. It's a based on a person's facts and circumstances, and is generally suited for people who are living overseas on very long-term assignments or indefinitely or permanently, and it's generally not a good fit for people who are being sent overseas for work purposes for a couple of years. So we're going to focus on the physical presence test. That's the test that most of your employees are going to want to utilize to qualify for the exclusion. And in order to pass that test, it's a mechanical test that basically is counting the person's days in the U.S. and overseas. In order to meet the physical presence test, that person must be overseas for a full 330 days during the calendar year, if they're going to use the exclusion for a calendar year period, or for the fiscal year, they're going to try to get a prorated exclusion. So I should also note that presence in the U.S. for any reason is counted towards the 35-day limit that they're allowed to be present in the U.S. So once a person is expected to qualify for the exclusion, it's important to know that there are limits to the exclusion and to understand the mechanics of how the housing exclusion works. So the limit for the foreign income exclusion for 2017 is $102,100, and that would be for someone who's overseas for a full calendar year. The housing exclusion, in order to qualify for that, the person must have foreign housing expenses that exceed a floor, and for 2017, that floor is a little over $16,000. And then the exclusion has a cap as well, and most cities have or utilize the standard expense cap, which is $30,630. So for someone who's spending at least that amount in foreign housing costs, they're going to end up with a little over $14,000 in additional exclusion to help offset their income tax. So for someone overseas for a full year in a standard cost city, their exclusion would be a little over $116,000. Now, the IRS understands that not all locations have the same cost of living, so they've identified numerous cities that have a higher expense cap. For example, the cap can be as high as, based on 2016 limits for Hong Kong, $114,300. So someone's exclusion, if they were living in Hong Kong and had foreign earned income of a couple $100,000, they could exclude almost that amount utilizing the foreign earned income and housing exclusions. I also want to point out that when a person moves overseas in the year of their move, they can qualify for a prorated exclusion. So for example, if they moved overseas on July 1, and they met the physical presence tests because they were outside the country for 330 days between July 1 and the anniversary of that date, then they could qualify for roughly half of the foreign earned income and housing exclusion that would be otherwise allowed to them. And also, if the person's overall compensation package is in excess of the exclusion, because that helps out for people who have compensation packages on the moderate to lower end when you add up all their allowances, then if there's someone who's highly compensated and are paying tax in a foreign country, they can utilize the foreign tax credit in addition to the exclusion and to help lower their U.S. tax burden. So here's some forms and resources that you should make available to your overseas employees. One of them you'll need to have in your files for employees that are expected to qualify for the exclusion so you can administer their payroll correctly, and that's Form 673. What that does is that provides an exemption from federal income tax and some state income tax withholding, and that's basically the employee fills out the form. They certify that they expect to qualify for the exclusion and provide their level of housing expenses that they anticipate, and basically are outlining what level of exclusion they expect, and then the organization does not have to withhold federal income tax and possibly state income tax on their pay up to that level of income. And then if their income is beyond that, then they would begin withholding after their total compensation for the year exceeds that limit. The form 2555 mentioned here is the form that your employee will use to claim the exclusion. Also in the instructions to that form, there's the listing of the high-cost cities. So that's a very handy instruction to have available. And then publication 54 is the publication the IRS has put out that outlines the foreign earned income and housing exclusions and other information related to U.S. citizens and resident aliens that are living and working overseas.
Okay, we have arrived at our first polling question. Does your organization provide professional tax advice or tax filing assistance for your expat employees? Initial consultation of annual allowance, reimbursement for actual costs, direct payments to tax professionals. A is yes, B, no, C, no, but we're planning to. After you make your selection, please hit submit so we can see your answers. Also at this time, I will give you the first CPA word. It is expat. As a reminder, at the end of the webinar, you will be asked to take the survey and ask for the 3 CPE words. Once again, it's expat.
Thanks, Sharon. I see the poll results are coming in, and it looks like 70% of you do not provide professional tax advice or assistance for your employees in any manner. 18% of you are providing some sort of assistance, and 12% of you are planning on it. It's a little surprising that such a high percentage of organizations aren't providing some level of support. Now, we recommend that all organizations provide some type of assistance for those with complicated tax situations involving employees who live and work internationally. Now I'm going to cover our next topic, which is state taxation. This is a topic that comes up all the time, both at the individual and organizational level. I find that it's common for people when they move overseas on a long-term assignment that covers multiple years that they are under the impression that they don't have to continue to file a state tax return where they were living when they left the country. Unfortunately, that's not the case in most circumstances. States tax their residents in one of 2 ways. Basically, they are considered either a domiciliary resident of the state or a physical resident of the state. So we're going to cover domicile here today. That's basically a person. Most states believe that a person always has a place of domicile. And if one of your employees has been living and working in the state of Maryland, for example, and they leave for a 3-year assignment overseas, Maryland's going to say that that person is still linked to their state and that that's still their state of domicile. So it's important to understand at the organizational level how your employees are taxed under different states' domiciliary rules. So there's a few different ways that states tax their domiciliary residents. The first one is based on worldwide income reporting. So basically, it is as if the person never left the country. They still file a resident tax return in their state of domicile and report all of their income. Now, under that scenario, there's 2 different outcomes. You can have an outcome where the state conforms to the federal rules related to the foreign earned income exclusion. And in that case, the state's going to allow the same level of exclusion for the regular exclusion and the housing exclusion. So that's very helpful if the person was a resident of that state when they go overseas, obviously. The tricky part can be when the person is domiciled in a state that does not conform and allow the exclusion. Obviously, you could have a result where the person is not having to pay any federal income tax, but they still have to pay state income tax on all of their income. Now, there are a handful of states that treat their domiciliary residents as non-residents for tax purposes, and it's important to understand that there are states out there like that. Basically, each state will have its own requirements, but in general, there'll be some sort of a day limit where the state would say that as long as the person is overseas on a long-term assignment and doesn't spend more than X number of days, say 30 days in their state during the year, then they're going to treat that person as a non-resident for tax purposes, and their wage income and other income that's earned outside of the state is not reportable. So those types of states are very beneficial if the person happens to be lucky enough to have lived in one of those. So they end up with, in most cases, very little tax liability while they're living and working overseas. Then, of course, the real lucky ones are the ones who live in the states that had no income tax to begin with, because they don't even have to worry about this particular issue. So I often run into a question, well, from an organization or an employee that is interested in changing their domicile. So changing one's domicile is not an easy thing to do. Most states require you to cut all ties with their state and take affirmative action to create a link to the state or country that they're living in order to effectively change their domicile from one place to another. So sometimes it can be easy to cut ties with one jurisdiction, but it's often not easy to create ties that would establish domicile, especially in a foreign country, but also in another state if the person is doing this after they left, after the fact. They haven't done any planning and they would like to change to Florida or Texas, a no-tax state, while they're out of the country. They have no intention to come back to the state they left, but they didn't take any concrete steps to do that before they left. So, and in that circumstance, they would most likely still be domiciled in the state they were living in when they left the country. So at the organizational level, this creates issues because employees often either ask HR or payroll to not administer state withholding because they don't think it's necessary. They don't understand the domiciliary concept, or they provide a state with no taxation, like Florida or Texas or Washington, and then they all of a sudden claim that as their home of record or their domiciliary state the day they leave. And that, from an organizational standpoint, I mean, the domiciliary issue is really an individual tax issue, whether they're filing in the correct state. But at the organizational level, the organization needs to have some sort of evidence in their file as to what the home of record is, and some proof of home of record, I think, such as a driver's license or utility bill, especially if the person is changing it from the state you've known them to live in for years to one of these states with no tax. They should provide you with some sort of document that shows they've done something to actually change their domicile to a new state. So it's important to understand the different ways that each state taxes your employees, to understand if they could be in a state where there's a non-residency provision or there's no income tax, and then also documenting when the person's made a change. One mistake I have seen at the organizational level is when an employee doesn't provide information about their state in a timely way, that the organization just defaults to the state where headquarters is and starts withholding there. Maybe the person moved there briefly for some training before they went overseas, and there was some income tax withholding done then, and now all of their wages are having that state's income tax withholding. And handling that way just becomes a messy deal because the person usually has to go back and file a non-resident return and get their money back, or the organization has to amend payroll reports to get the money back. So don't default to the headquarters state if you don't have the right one. Make sure you pin your employee down to get them to claim what their state of record is. So now we're going to go on to our next topic, which is taxation of overseas allowances.
Hi, this is Kate again. I wanted to talk to you this morning about some of the overseas allowances, and are they taxable? Why are they taxable? And also the goal, to talk about the goal. The goal here is to have no W-2 surprises. Generally, the expat team that we discussed briefly on the first slide should approve of the typical compensation package. They may not be the ones that do the nitty-gritty and put the package together, but they definitely should know what is the organization's compensation package and what is taxable on that package. Many organizations will put evacuation insurance or some sort of an allowance for medical while overseas. They may or may not be taxable. So the expat executive team should be aware of what the typical compensation package is for their organization. The next thing you need to do is make sure that you document all the allowances and provide this information to your employees during the hiring process so that they know before they leave the United States or the country that they're working in and going to a new country, what is going to happen to them once they get on the ground. It would be wonderful. I highly recommend that each organization provide each expat employee with a list of documents, Form 673, Publication 54, a checklist of all the kinds of things that they need to know, a day calendar, other IRS publications, and a copy of your HR expat policies. This can be done through email, and it's very supportive of your employees and keeps them happy. Also, another thing that will keep your employees happy is to provide timely statements to your employees, detailing all their taxable income and taxes withheld throughout the year. You could break out each payroll period showing all the taxable payments, cash and non-cash, and non-taxable too. In other words, you want to give them as much information as possible so there are no W-2 surprises. What are the certain allowances that are common to a compensation package? Well, there's the base salary. Some organizations I work with have maybe one base salary and a housing allowance, and that's it. Other organizations, because of where they're sending their folks and who they're sending, have different kinds of allowances in addition to the housing and the base salary. The cost of living allowance, or called post-differential, this is to afford the employee a similar standard of living as if they had stayed in the United States. In a country where security might be an issue, the employee would be afforded a security allowance and maybe danger pay, also called hardship allowance. If the employee goes over there with a dependent, your organization may have an educational allowance policy up to a certain amount. If your employee goes over without their family, they may be given a separate maintenance allowance. And another minor allowances are usually the settling in allowance, R&R, TQSA, and auto personal use, and then there's the home leave allowance. If you send someone home for a period of time, and many organizations require home leave, this is taxable to the employee. So all of these allowances that I've listed here are taxable. The auto allowance would be the personal portion unless it was a de minimis amount.
Okay, this takes us to our second polling question. Does your organization have an expatriate policy and procedure manual? A, yes. B, no. C, no, but we are planning to. Please remember to hit submit after you answer the questions. At this time, I will give you the second CPE word, and that is tax. Once again, the second CPE word is tax.
Thanks, Sharon. The answers are coming in, and it looks as if 33% of the respondents do have an expatriate policy manual. That's great. That's great. 55% of the respondents do not have a manual. Not so great, but let's work on that. That gives you some new goal for the year. And 12% of the respondents don't have one, but will in the future. So that means that 45 will have something in the future, and 55 don't have, but I challenge you to get that in order. We certainly do recommend having a manual in place to ensure proper order. At this point, I'd like to talk about host country taxation. Well, why are we talking about host country taxation? Over the last 30-some years, I've been involved in expatriate taxation since the early 80s. The IRS has changed its tax policy a few times, but what we've seen the greatest change in this whole area is that host countries are now taxing not only employees, but TCNs, your third country nationals that you're sending to a country to work for you. So the best possible position to take is to assume that your employees will be taxed. And in some cases, it could even be consultants. There are ways to find an exception, as Troy was mentioning earlier. There are tax treaties. This is a treaty between the United States and the host country. There are bilateral agreements. This is between a U.S. agency, usually, the State Department, and the host country. And there are memorandums of understanding, and this is usually between an organization like yourself, NGO or for-profit government consulting firm, and the host country, where they say, oh, hey, look, we're going to send our doctors over to you. It could be a hospital, and we want them to work with your doctors in your hospital, but we'd like not to have them have to pay host country taxes. And we would like you to understand that, and let's see if we can make an agreement. So if you cannot get an exemption from host country taxation, there are typical tax policies that are available to your organization: tax protection, tax equalization, hybrid, and other. We'll talk about the advantages in a minute and go over the definition. And we'll also talk about what your leadership can do to minimize the risk. Here is an example of the impact that host country taxes has on someone who works in a foreign country compared to the same person who stayed home. And the comparison has to do with the taxable compensation. You can see the difference is over $50,000. And the cash that they take home in their pocket, the cash that they have available to pay the mortgage and buy groceries and send their kids to camp or pay for babysitters. The column on the right is the expat. The column in the middle is the domestic person or the same person who stayed home. And the far column on the left describes the field. If you go down to the bottom line, you can see that the person who went overseas has less cash. Why? Because they had to pay almost $40,000 in host country tax. And if it was reimbursed in the next year, it would be taxable income to them in the next year. So it becomes a dog wagging the tail, or a dog chasing its tail, rather. Now let's talk about the tax policies. The first tax policy is tax equalization. I'm going to do this very quickly so you have an idea. This is an overview. It means that you're not going to penalize the employee who goes overseas. You're going to say that they will not pay more total home and host country tax than if they had lived and worked in their home country. The employee pays the same amount of tax, withholding tax, to your organization through the withholding as if they were living and working in the United States or their home country if they're a TCN. And then the employer pays the foreign taxes and any home country taxes that are related to the organizational income. Who benefits? The employer benefits if there is no foreign tax or low foreign tax, host country tax. Tax protection ensures that your employee does not pay any more total home and host country as if they had lived and worked in their home country, same as before, but the employee pays his own home and host country taxes and only requests reimbursement from the organization if the total amount of the home and the host is more than he would have paid if he'd stayed home in the U.S. or in the case of a TCN in the home country. Who benefits here? The employee would benefit if the total home and host country taxes were less than what the employee would have paid if they've lived and worked in their home country or stayed home in the U.S. Finally, the most common thing we see with the organizations that Troy and I work with is an approach to combine the two, and it's called a hybrid. And this is something that allows you to give a peace of mind that you have a tax policy, that all your employees will be in compliance with local tax law. If there is no foreign tax in the host country, there's no impact, there's no policy. If there is tax imposed by the host country, there are a number of things you have to go through to reach your hybrid. You have to determine the employer-employee compliance obligations. You have to evaluate your tax planning opportunities, calculate the employee hypothetical tax, calculate the employee foreign tax, implement tax equalization if the tax is higher, and implement foreign withholding host country tax if the tax is lower than the hypothetical. As I said, the benefits of the hybrid approach are that the organization is compliant, the employee is in compliance. You can also include third country nationals, TCNs, in this. However, it may not be cost effective. And this is the challenge of all three types, that it will be costly to administer, it will be costly. You may have to hire additional staff. You may have to consult with a local CPA firm to review the hypothetical tax returns. There are other hidden costs, but you need to know this is a serious undertaking. But this is what a lot of organizations are trying to do on a case-by-case basis.
Okay, we have reached our final polling question. Does your organization have a host country taxation policy? If not, is your organization considering one? A, yes, we have one. B, no, we don't have one, but are considering one. C, no, we don't have one and are not considering one. With the final polling question, I will give you the last CPE word. That is host. Again, the last CPE word is host. Kate, what are your thoughts on the results coming in?
Thanks, Sharon. We just received the results from our last polling question, and I'd like to thank you all for participating. The results indicate that 15% of you have a host country taxation policy in place. That's terrific. 25% of you are considering one, so that's a total of 40%. Congratulations. There are 60% of you that are not considering one and do not have one in place. We strongly advise that you consider putting one in place. This will be a big source of confusion around tax time. It could be a big source, and we know your employees would appreciate it. Troy, you will now pick up the presentation and discuss foreign bank reporting.
Thanks, Kate. Yes, I want to take this time now to talk a little bit about the Foreign Bank Account Reporting Form, otherwise known as the FBAR. I'm sure a lot of you have heard of this form, but just to make sure that everyone's aware of it and the following requirements, I'm going to go over them now. So the Foreign Bank Account Reporting Form is required for all U.S. persons, which means all U.S. citizens and green card holders and entities that have been created or organized in the U.S. So those are the potential people that would need to file the form, and it's required when the U.S. person's foreign accounts in total, so when all of their foreign accounts exceed $10,000 or more at any point during the year. So that's the trigger, $10,000. So once you've hit that, you now know you have to file the form. The form itself must be electronically filed, and that can be done at the BSA e-filing website, the U.S. Treasury website. So you can go there and file it on your own, or you could have your tax professional file it for you. We do that, the FBAR reporting for most of our clients. The form this year, they changed the due date for it. It used to be due June 30th, which was out of sync with everyone's tax filing, which was a real pain in the neck. So they finally realized that that was the case and have created an April 15th standard deadline for this year, for 2016, and have allowed for an automatic 6-month extension without having to file a form. Now, in the future, they may create an extension form, but for now, everyone gets an automatic 6-month extension to create a real deadline of October 15th. So there is no tax or fee associated with the FBAR form, so it's merely an informational filing. All tax returns in the U.S. have some sort of a checkbox on one of the schedules that lets the IRS know whether or not you have this filing. So maybe the question has been ignored in the past, but I want to make sure I draw your attention to it so that you indicate on your 990 or 1120 or 1040, 1065, whatever it is, there will be a question on there that asks whether or not you're required to file the FBAR. Make sure you answer that appropriately. And if you've answered it yes, make sure that someone's taking care of the filing. So from an HR perspective, this is an issue because you'll have employees that have signature authority over the foreign accounts, but of course no financial interest in them. And this is also a filing requirement. So the second, most of the people file the form because they have a financial interest or ownership of the account, but there's also the same exact filing requirement for individuals who have no ownership but have signature authority. So this will be most of your project managers in the field or officers of the organization. Someone in the organization or multiple people are going to have signature authority over your foreign accounts. Those people have the same FBAR filing requirement. We have some of our clients that handle the FBAR for their employees, take care of the preparation of it from start to finish for them. And we have others that provide the information, before April 15th in this case, so that your employee can have that form done timely and provide the information to their tax professional. So at a minimum, it's not necessary to prepare the form for your employee. In fact, they may have their own foreign personal account that they would need to report themselves. So, if the organization files it with just the organizational accounts, then the employee would then have to amend the filing. So, in fact, it may be better to just provide the account information to each employee for the accounts they have signature authority over to them in a timely way so that they can handle the filing and, of course, alert them to the fact that they need to do it. There is a 6-year statute of limitations on the form. So if you are thinking to yourself, I've never heard of this form, we've had foreign accounts for years, what do we do now? The 6-year statute basically means you can go back and file 6 old returns now. The IRS would still be asking for those. And if there's no unreported income, or if it's just a signature authority issue where some people haven't filed to report that they have signature authority over it, then the IRS will accept your 6 old returns filed electronically, and as long as you submit your reasonable cause explanation. In fact, the IRS has 8, I think, canned reasonable cause explanations, so you can select one. But I think it's important that you go back and get those, to the extent you may have missed a filing, go back and catch up and get those filed. As I mentioned, there's no tax or fee associated with filing the form. It's informational, but there are or can be significant penalties for not filing. So it's important that you're aware of it and that you keep up with it, and your employees do too.
I want to thank everyone for your attention today. And before we wrap up, we've left 10 minutes for questions and answers. We've been receiving some great questions, so our experts will be glad to answer them. Our first question is for Kate. Where are the countries with the exempt status, and what are the implications of working in that country?
Oh, that's a great question. If you're referring to host country taxes, I don't know of any list that lists the exempt status, but they do list the countries. I know of Inside NGO, which I'm sure you're all familiar with, has a list of countries that do tax U.S. citizens and TCNs, and it's available on their website under 2016 Expat TCN Salary Allowances and Policy Survey. However, if you're referring to a U.S. corporation, which nonprofits are also, they want to get nonprofit status in that country. I don't know of any list. I know of a country, for instance, Zambia. If you want to have nonprofit status in that country, you have to organize a corporation in that country and file for exempt status and operate as a tax-exempt entity in that country. But I'd be happy to talk with you at another time about this.
Thanks. The next question received is for Troy. If an employee comes to the U.S. for official reasons, does that time also count toward the 330 days?
Unfortunately, it does not. So basically, presence in the U.S., so in order to meet 330 days in a foreign country, you're limited to 35 days in the U.S. So presence in the U.S. for any reason counts towards your 35-day limit in order to meet the physical presence test. So if someone's brought back for a work meeting, or they come back for vacation, or they even come back for a medical reason, a medical emergency, that all of those presence for any of those reasons is going to count against that person's 35 days. So it's very important when someone's being sent overseas on a long-term assignment and their expectation is to meet the exclusion, that they understand where they're going to vacation. Maybe they can take a vacation, outside the U.S., to make sure they don't hit the 35-day limit or exceed the 35-day limit. And you also, as an organization, want to make sure that you're not asking that person to come back for work reasons. They're going to run right up against that 35-day or exceed it.
Thanks. Kate, the next question is for you. Where can we find a list of cities with no caps?
Well, to the best of my knowledge, all locations for foreign housing have an expense cap. So what you want to look at to find the list of those countries and the cities in those countries or the areas in those countries near the cities, you need to go to the instructions for the Form 2555, and they're in the back of the instructions. And that's a different document than Form 2555. You can find it on the IRS website, irs.gov.
Okay, thanks. Next question is for either one of our presenters. Are you still required to withhold Social Security and Medicare for employees living overseas?
Kate, I'll go ahead and take this one. So the answer to that question is yes, in most cases. So when you have a U.S. citizen or green card holder who's working for a U.S. organization overseas, they are still subject to U.S. Social Security and Medicare tax withholding, and then the employer match still applies. So you could have a circumstance where you're administering U.S. Social Security and Medicare, and also that person's wages are subject to local country Social Security and Medicare tax. Now, one way to avoid having to pay into both systems or to only pay into the correct system is if the U.S. has what's called a totalization agreement with the country that you've sent your employee to. So the totalization agreement is in place between the U.S. and that country because that country has a similar Social Security system, and they recognize that they would be covered under both, and the agreement basically states which country the person pays into. So the person doesn't get to elect which country, but the agreement will state which country. But in general, your mindset should be that the person is still subject to U.S. Social Security Medicare tax, could be in the other country, and look for a totalization agreement to see if there's some way to only pay into one and make sure you're paying into the correct one.
Thanks, Troy. I'd like to also mention to you folks out there that hire consultants. They are subject to self-employment taxes, even though they may have no taxable income. So you need to be aware that sometimes they spend their money before they go and pay their taxes. Thank you.
Okay, thanks. Our last question is for Troy. If an expat fills out exclusionary form 673, is there a benefit to structuring their pay with allowances that could help them with their taxes?
Good question. So the 673, the purpose of the form is for the individual employee to quantify what level of exclusion they expect, combined between the foreign earned income and the housing exclusion. So the person's base pay and all of their taxable allowances are considered foreign earned income. So for this purpose, for figuring out how the 673 and what level of exclusion they're going to get, all of their total compensation package would be eligible to be excluded to the extent it's not earned in the U.S. So not much thought really needs to be given here in order to, just worry about whether someone should have a higher base and lower allowances, or a lower base and higher allowances for purposes of the exclusion. All of that's foreign earned income. All of it's eligible to be excluded as long as they meet the physical presence or the bona fide residence test.
Okay, thank you, Troy. At that, I'd like to wrap up the webinar for today and want to thank everybody for attending. Please see the contact information of our presenters. Feel free to reach out with any questions you have concerning expatriate taxation. They would be happy to help. Also, we received a number of questions during this webinar that we were not able to address. We will compile all the questions you submitted and circulate the answers later this week. Don't forget to turn off your pop-up blocker so that you can take the survey at the end of the webinar and receive CPE. I want to thank everybody again and hope you have a great day. Thanks.